Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Monday, July 20th, 26, and we have a packed show. Big tech earnings season kicks off this week with Alphabet, Tesla, Intel, and IBM all on deck. The semiconductor sector is deep in bear market territory, and the crypto market is wrestling with serious regulatory uncertainty. A lot to get through, so let's get right into it. Lizzie, futures are edging higher this morning with the Nasdaq leading at around 0.7%, but we just came off the worst weekly performance of the quarter. What's the setup heading into this earnings week?
Morning, Robert. The market is essentially in show me mode right now, and that's the only honest way to describe it. Last week, the Nasdaq fell nearly 3%, the S&P 500 dropped 1.55%, and the Dow was off close to 1%, with semiconductors driving most of that damage. Futures are bouncing this morning, but it's a cautious bid. Traders aren't committing size ahead of what could be the most consequential earnings week of the year, because if Alphabet, Tesla and Intel fail to demonstrate that AI spending is actually converting into real revenue, this morning's green could evaporate very quickly.
All four of those names report this week: Alphabet, Tesla, Intel, IBM. Which one carries the most market-moving risk, and what are traders actually watching for?
Alphabet is the one that matters most to the broader market right now, and the key number isn't just EPS, it's capital expenditure guidance. Because if Google signals any pullback in AI infrastructure spending, that ripples directly through the chip sector and into names like Nvidia, Broadcom, and AMD. Tesla is the other high-stakes print, given where EV sentiment sits, but from a systemic risk perspective, Alphabet's capex commentary could either stabilise this sell-off or accelerate it, and that's why traders are positioned defensively going into that print.
The SRX ETF is now officially in bear market territory, down over 20% from its June peak. Ed Yardeni is warning it could fall another 12% from here. Is the semiconductor sell-off overdone, or is there more pain ahead?
Yardeni's concern is grounded in something real, and what makes this sell-off particularly uncomfortable is that it's happening against a backdrop of genuinely strong earnings. TSMC reported a 77% profit jump, Samsung posted a 19-fold increase in operating profit, and both stocks still fell. When the market punishes results like that, it's telling you the issue isn't the numbers, it's the valuation multiple. And the worry is that AI-driven chip demand has been pulled forward and may be overheated. Until Alphabet and Intel confirm that hyperscaler spending remains intact, the path of least resistance for stocks is still lower, and that 200-day moving average Yardeni is referencing is a meaningful technical target.
Memory and neocloud names like Micron, CoreWeave, and Irian are bouncing in overnight trading. Is this a genuine dip buying opportunity or something traders should approach carefully?
Retail sentiment on StockTwits is bullish on these names, but I'd treat this with real caution. Micron is up about 2.5%, CoreWeave around 1.2%, and Irian near 1%. Those are not the kinds of moves that signal institutional conviction. Those are speculative bounces in a technically broken sector. The structural concern around AI commoditization from China's Kimi K3 model hasn't gone away. And until the hyperscaler earnings confirm sustained capex, buying into the memory and neocloud space here is a high-risk trade.
On the geopolitical side, US-Iran tensions are escalating, and Brent crude has been swinging between $82 and $90, depending on the headline. How are traders positioning around energy names like Oxy, XOM, and CVX? And is defense a legitimate trade here?
The energy trade is getting interesting because oil is sending mixed signals. You had Brent briefly above $90 on the US-Iran escalation headlines. Then it pulled back as Iran signalled continued diplomatic channels, which shows just how headline-sensitive this market is right now. Oxy, XOM and CVX are all seeing pre-market bids, and Lockheed Martin is worth flagging too. LMT popped after unveiling 2 new counter-drone and missile defence systems. And with geopolitical risk this elevated, defence isn't just a news-driven spike. It's a structural trade tied to a multi-year spending cycle that has real durability regardless of how the near-term Iran situation resolves.
Steve, the last initial jobless claims print came in at 208,000, well below the 217,000 forecast. Does that kind of labour market resilience change the calculus for the Fed at all, especially with oil prices reigniting inflation concerns?
The 208,000 print for the week of July 11th was a notably solid result, coming in 9,000 below consensus and also below the prior reading of 216,000, which signals that the labor market is holding up with more resilience than many economists anticipated, given the geopolitical noise and tightening financial conditions. For the Fed, a tight labor market cuts both ways right now. It reduces the urgency to cut rates on growth concerns, but with oil prices adding fresh inflation pressure from the US-Iran situation, policymakers are watching two competing forces simultaneously, and a strong jobs market gives them every reason to stay patient and hold rates at their current 3.5% to 3.75% range.
The next jobless claims reading drops Thursday. What would a surprise in either direction mean for markets this week?
Thursday's release covers the week of July 18th, and consensus is sitting at 212,000, which would represent a modest uptick from last week's 208,000, but still reflect a healthy labor market overall. A reading below 205,000 would reinforce the Fed's hold posture and likely put modest upward pressure on Treasury yields, which are already competing with risk assets for capital. On the other hand, a surprise above 220,000 would be the first real crack in labor market resilience we've seen in some time, and in the current environment, that could actually be read as risk positive by equity markets, giving the Fed more room to consider cuts, though the inflation picture from energy prices complicates that calculus considerably.
Lizzie, over to crypto. Ethereum dropped 2.7% after a Politico report suggested the Clarity Act may not have enough Democratic votes to clear the Senate, and nearly $400 million in liquidations followed. How serious is this regulatory overhang for the broader crypto market?
This is a significant overhang, and the numbers bear that out. The Clarity Act's polymarket odds have collapsed from 82% in February down to a record low 32% today. And when you see 335 million of that 400 million in liquidations coming from long positions, it tells you the market had been pricing in regulatory clarity that may not materialise before the August recess. Ethereum is the most exposed because its institutional narrative is so tightly bound to regulatory legitimacy. The comparison to Amazon before AWS is compelling. But that thesis requires a functioning legal framework, and without the Clarity Act, institutional adoption timelines stretch out considerably.
Bitcoin ETFs just broke an 8-week outflow streak with $273 million in inflows. Is this a real inflection point for institutional demand or just noise?
Honest answer. It's closer to noise at this stage, and analysts are right to call it peanuts relative to the $8 billion that left during those 8 weeks. Bitcoin is range-bound between $63,000 and $65,000, and while traders have placed notable bull call spreads targeting $70,000 to $72,000 by July 31st around the Fed decision, a sustained structural return of institutional demand needs consistent weekly inflows over multiple weeks, not a single 2-week blip. Visa's entry into the stablecoin space with OpenUSD is adding competitive pressure on Circle and Coinbase. CRCL is down over 5%, and Coin is off around 2%. And that's another layer of uncertainty the crypto market doesn't need right now. The one genuinely constructive story in the space today is Hut 8's $9.8 billion AI data center lease, with shares up around 5%, showing that the intersection of crypto infrastructure and AI computing is still attracting serious institutional capital, even amid the broader uncertainty.
That wraps up today's Morning Bell. This is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.